Well, greetings to all, and across this land as we start with our NFP updates, where we're going to cover the three topics of Payday Super, Contractor Super, and tax exemption reporting. So, move on to, I'd like to now acknowledge the traditional owners of the land upon which we meet today across all of Australia. We pay our respects to to elders past, present, and emerging. We extend that respect to any Aboriginal and Torres Strait Islander peoples who are joining us here today. And so now I'd like to introduce our housekeeping issues. So if you have a question, there is an opportunity to submit that. And following on from the session, you'll be sent the slides so you can receive those in front of you to have a look at, and the details of each of the three speakers so that you can follow up with any questions. Now, to introduce our three speakers. Well, myself on the right, Russell Postle in the Brisbane office. We're also joined by Judy White, who does the specialisation around the payroll, and Stefanie Merlino, who's similarly specialist around employment services and expatriate services. So let's move on to our first topic now, which will be the tax exemption reporting. So that is to look at the new rules that are applying across the income tax world. So the focus is on non-charity self-assessing as income tax exempt, and it's important that we get those terms understood. So it was announced, whilst it was announced in the 2021 federal budget, there's been a long gestation period as the development has been occurring. So it covers non-charitable NFPs with an active Australian business number. Those charities that wish to continue to access an income tax exemption, because it's not automatic. So all of those are required to lodge an annual self-review return. The original lodgement due date was 31 October, but that has now been extended for this first year through to 31 March. So let's have a look at the categories of what is Division 50, the section of the income tax law that allows an income tax exemption to various categories of entities. So 50-5 is charities, education and science. Then we've got the community services like Rotary, Zontas, the employee and employer associations and trade unions, funds contributing to other funds where it goes through retaining exemption, government, health in private hospitals, other hospitals and health insurers carried on by an NFP, the NFP to promote the development of aviation, tourism and some other limited development activities, societies for the encouraging sport, literature, art, music and animal racing. So they're the categories as listed in the Act. But then let's face who is excluded from that they don't require to. Well, firstly, charities, because they already lodge an annual information statement, right? Let's remind ourselves that this is for non-charities who are self-assessing as income tax exempt. Similarly, government entities are not required to lodge this return, and that NFPs that are taxable, that are already lodging under the mutuality principle, they continue to lodge their income tax return. This is only for those that class themselves as income tax exempt. Now, for those of you who use a GST sub-entity, they are for GST purposes only and do not lodge a separate return. So now let's have a look at the return. First off, the easy bit, who are we? ABN, and then an estimated gross turnover for the year ended 30th June 2024. If you have a different financial year, you move and pick up what those numbers are. So of course, small is 0 to 150. What's the significance of that number? Well, 150 is the threshold at which you're required to be registered for GST and accounting for GST. So that means that if you say that you're more than 150 and you're not registered for GST, expect a phone call. The turnover, if an entity has a GST sub-entity, the turnover must include the sub-entity's work as well. So, and then you've got the split. So all you've got to do is tick, yes, I'm in this category. It's not put your dollars in there, but just to tick which category you are. So let's move to step 2. So this is the significant bit. You've got to choose the category that of NFP, and this is the ones that you'll see on the return. Community service, cultural, educational, employment. They do indicate also the government, which then just ticks you straight out of the system. But health, if you're a hospital, health if you're a private health insurer, scientific, sport, or if you're none of the above, it's going to be an interesting question you'll get back as well. So each of the NFPs, they need to understand just which category or categories under Division 50 applies to them. You need to be able to say, well, I'm a Rotary Club, therefore I fit under community service. I'm a sporting entity, I encourage we encourage sport, that's what it's all about. But an entity might also have a secondary object, or secondary category, but it's which is the primary category that you are ticking as to your categories that you apply. So you need to be able to look at the objects and to match that one. So let's move on to what is then question 3 in the return. Are you an NFP? Does the organisation have clauses that prevent, firstly, the distribution of income and assets to members whilst operating and on wind-up? If the answer is no, then the entity fails the definition to be an NFP. In Queensland, the big issue sits around the parents and citizens for state government schools because of the wind-up clauses. So remember that NFP is not about not making a profit or a surplus, but it's not a profit by the members or for the distribution to members. There is a transition rule that if when you go through your governing documents, your constitution for most, and you say, yeah, we're not quite complete there, there is a transition rule to allow you to update your documents by 30 June 2025 and still qualify, right? So it's a very significant transition. Check your constitution. And if provided that you live by as if those clauses were in there at all times between now and when you do the amendment, then that's okay. So let's move on to question 4. Does the organisation exist and operate and it's entirely in Australia? Read entirely as 100%. If you cannot answer yes, that's not necessarily a major problem because the law requires that the organisation operate and incur its expenditure principally in Australia. So it's not about where do you receive the income from, it's where you apply the assets and expenditure. And principally is more than 50%. You know, for example, if you're a sporting organisation and you send someone to go and be at the Olympics to test that, and you reimburse them, then some of your expenditure is incurred outside Australia. So it's not a bad thing, not a failure, but it's just a question of that. Those are the questions that are on the return. So you know, you do need to be able to evidence that. So, are you a charity? Was question 5, in which case the return doesn't apply. But there's a trick question. Does the organisation have any charitable purposes? Don't read that as, hey, we're kind and caring. We're charitable, we're friendly, we're kind, we give away money. A service club, Rotary or similar might think of them, well, we are charitable with the way we do things. If you tick yes, then because the options you're given are yes, no, and unsure, if you tick yes or unsure, you're going to get a call. You're going to get a follow-up because if your clauses are charitable, then you are required to be registered as a charity. And to access the Division 50 exemption, an entity with charitable purposes is only exempt whilst it's a registered charity with the ACNC and is endorsed as exempt by the ATO. So you can't say, oh, well, we're charitable, but we're still a community service, because Section 50-47 denies access to a second category, any other category, if you are a charity. So if you are regarded as a charity by definition, because of your clauses in your constitution, then you can only gain income tax exemption by being a registered charity. It's a very, very strict test. So be very careful with that question, and do not read it as, yes, we're kind and caring. Read it, are we a charity? Refer the definition of a formal charity, because from Rotaries, they're not a charity because of the nature of them. They're a service club, community service. Big distinction. They don't fit the definition of charity, for example. So let's now look to what are some of the overarching requirements that are sitting, that when you're completing this form, that you require that for the categories, for those, be it a union, be it a community service, and encouragement of sport, scientific body, promotion of tourism, all of those, then you've got to live by these rules. You must have a physical presence in Australia, and to that extent incur your expenditure and apply your assets principally in Australia. Remember that, 50%. More than. The entity must comply with all the substantive requirements in the governing rules and apply its income and assets solely for the purpose for which the entity is established. So let's just turn to the governing rules bit on the next slide. The governing rules requires that it must comply with all the substantive provisions. So it means that if it's a minor provision that is not significant, then the failure to adhere to that is not going to take away your income tax exemption. Because this is at all times. You get things that give rise to the object, and what are the objects, the purpose of the entity. That they give rise to the non-profit status, that is, the inability to distribute to members during operations or on winding up. Set out the powers and duties of the directors or the officers, committee, management committee in incorporated associations. Those clauses that whatever they say regarding financial statements, how to be prepared, criteria for how to enter a member into the register. They might require you to maintain a register of members, and those all that relate to the winding up. They are the ones that the ATO is listing as substantive. So you need to be able to say, well, which clause is us? It's clause 8 for this, clause 9 for that. You need to know which one is which. So let's move now to the application of objects, because the second test that is required is that the entity must apply its income and its assets solely for the purpose for which the entity is established. Now, this apply means that it is linked to every transaction and every asset, not just, oh, well, they're the ones that we use, and they need to be able to link the transaction to the purpose. Now, solely, whilst it's not defined in the particular Division 50, it's had an enormous amount of case law, particularly in the world of superannuation. And that has been defined to be 100% to purpose, nothing less. It's a full 100%. So it means that you've got to look at how you deal with the income that you generate and the assets, bank, cars, property. Are they all being used for the purpose? And a good way to think of it is that it does not matter where the income is generated from, it's what you do with it that matters. That's the test. It's how you apply it. That's the test that is constant, that you've got to be able to cover. So let's move to the summary. So what do you need to do to be ready? You need to review your constitutional / governing documents. And the term governing documents is used through the legislation and everything because some organisations, some are unincorporated, they don't have a formal constitution. They have a set of rules. They become the governing documents. So you need to identify the clauses that prohibit distribution to members, both whilst operating and on wind-up. You need to identify which are your substantive provisions and the fact that your adherence to those provisions. You know, if it says, if your rules say thou shalt have an audit, then you are required to have an audit, even though the legislation for the Incorporated Association might have relaxed that. You need to modify the Constitution if your Constitution still requires that. So you need to look at your websites. We've actually had an example where the ATO questioned a sporting entity that had a bistro. Why? Because they were promoting the bistro because that was where they got their income from. They were focused on that because that was how they funded their maintenance of their sporting fields. So they need to be able to show that the organisation's first and primary focus is about the management, or in their case, it was about the encouragement of sport. So you need to be able to say, well, we're going to buy a new glass washing machine. Well, how's that? And then it might come up in the minutes of the management committee. Well, we're buying that because it will allow us to generate more income in the bar or in the dining facility, which will then allow us to better maintain and encourage people to participate in sport. So you need to close the loop, as we refer to be able to show how each piece is there either directly for sport, or it's about, if it's a sporting entity, but pick what the objects are. So you need to be able to link that back to each. Do the financial statements, share the correct message. Are they the reports? And that's generally that one to show that. So you need to ensure that the focus is on the objects at all times, and that how do you link the actions. One of the risks for some organisations is what's referred to as bracket or creep, or the object creep, your mission creep, because you say, well, this is what our objects are, but then just gradually you say, oh, there's a little bit extra need over here, there's a little bit extra need there, and so you start just doing that little bit extra, and then suddenly you find, well, hang on, we're actually doing something that wasn't covered under our objects. And if we go back to the tax rulings, they give an example of an organisation that was set up to help women that then starts helping some men. Well, that's outside their objects, and so that can then risk their income tax exemption. So you need to ensure that your objects are current. So periodically, every year, you check the objects. Are we still living these? Are they appropriate? Or do we want to look at changing those? So there's a lot of work to do there, and you've got till the 31st of March to lodge that form, but you need to do it. It's not just a simple, oh, tick the box and get rid of it. We need to be very conscious of what is being completed, ready for the lodgement, because this is about the ATO understanding who it is. They've been out trying to understand who is there, which is why they've chosen the ABNs, because they start with the ABN list and go, well, we've got all this list of organisations, but is the ABN register up to date? Quite often it's not. And so, ideally they've been sending letters to organisations, but that'll only be the last address they have. And the ATO is expecting to find a number of entities that are more truly described as charities. They're expecting to find a number of entities that think they're exempt under Division 50 and are not. And then those entities that may need a little more work to get them to be able to maintain exemption. So it is a very particular area that is coming. It is there, and at the moment the ATO is operating in the mode of assisting, guiding and supporting, but expect to see that if you don't lodge your form, you'll lose your income tax exemption as the next phase. That will be following. It's not there yet, but it is the logical next step, that if you don't lodge, a bit like if you don't, at the ACNC, if you don't lodge your annual information statement, double defaulter, gone. they'd say, well, if you can't lodge your AIS, you can't be registered as a charity, and you can lose it. And that's without any other compliance actions. So it's a very important area. But now we're going to move on to Payday Super, and a topic that Judy has been leading and doing a lot of work in, pushing forward the practical issues that are there with this, because that's the challenge lies. And Judy was helped pull together the BDO submissions on this, so she's the perfect example to be able to talk you through all these issues. So over to you, Judy.
Oh, great. Thank you very much, Russell, and what a lovely introduction. That was really interesting to what you have covered and really valuable information. Good morning, everybody. Thank you for joining us today. So we're going to start out looking at the current system. Now, may I just say, also as a bit of an introduction, that we're going to just focus on what we know should happen. So we are waiting on more details at the moment, but in essence, it is meant to be moving from a quarterly system. So you'll see a real focus here. Probably get a little bit sick of me continually coming back to quarterly over the next, little while, 10 minutes or so, while I just try to focus in on what those changes are going to be. So what is the current system? What is the fact that it's on a quarterly system at present, and noting that quarterly is going to change in future. So current system is the super guarantee regime. It does operate on a self-assessment system. So we are meant to all go and do the right thing and apply the rules. It's, as I mentioned, it's a quarterly basis, and it's your typical quarters being your 30 September, 31 December, 31 March and 30 June. And the contributions, really importantly, for this current environment that we are in, the super guarantee contributions are due within 28 days after the end of each quarter. You'll see on the right of that particular slide a handy table that just goes and provides those due dates for us for every year on the quarterly system. Now, so just moving on, the objective of Payday Super, there are two alternate models that have been proposed in the consultation process. Also, just noting, the Payday Super is currently proposed to start from 1 July 2026. Some of you might be sitting there thinking, that's not really that far away. Well, it's not, and there are really quite widespread changes to the super guarantee law that would need to be required to affect the objective of the Payday Super as we currently know of through the consultation process. Those two alternative models gives us an insight into the objective. So you can just see there on the slide those listed there. The first model that's been proposed is that employers will be required to make super contributions on the same day they pay salary and wages. So hence Payday Super, that's very clear with that model. Alternatively, however, is also proposed that instead of on the same day as pay the super, that employers will be required to ensure those contributions are received by the super fund within a certain number of days following payday. So still that objective, first step is thinking that the super will be required to be contributed on payday, but just noting that one of the models may provide some buffer. Moving on now to the, in particular, some impacts for the not-for-profit industry. Just really wanted to bring this back now as to what you may find particularly important to your industry. And we've just looked at three key features that we have noticed we thought would be worth to mention. So you can see there that we have the onboarding, of large numbers of employees. So just noting that from our experience, more often than not, we notice throughout the industry there are larger numbers of employees, often because they are taking shorter shifts or shorter engagements. And so that's quite common, that especially in the disability space. So you may identify with that you will have shorter engagements, and in order to achieve your objects of your organisation, you may find that you are dealing with a lot of employees. What does this mean for you? Well, the whole onboarding process in terms of super guarantee, and I probably don't need to sit here and tell you that if you're, you know, are affected by this particular one that we're talking about now, because you will be well and truly aware of the continual and regular administration that you go through to onboard those individuals and to continue to meet the super guarantee compliance requirements. But that onboarding and obtaining super fund details, yeah, that we hear you. That is quite an extensive exercise. Now, if you for a moment imagine your obligations are as at payday, then that gives you an insight into the gravity really of the changes that could be coming as early as 1 July 2026. Secondly, we just wanted to talk about smaller payments. So again, that fits in nicely with the first point, but also generally we experience that in the industry, the amounts, regular or smaller payments, and what we just wanted to point out that it doesn't matter how much the quantum of the payments are, there's still that, generally speaking, that amount of administration that you have to go through, and it's the same, if you like, no matter what the quantum. So that can be an impact in the industry as well. And lastly, nominal super shortfalls. So if there is unfortunately an issue that has arisen in terms of the super guarantee obligations, and unfortunately an error or a late payment has occurred and therefore have triggered the charge, the super guarantee charge to apply, what we find, and this is absolutely the case across the board, if that sort of thing happens, it's honest, inadvertent errors 99% of the time. But the current legislation does apply quite harshly to that. And also just noting that part of this process with Payday Super is not just focused on the change in timing to payday, but it also is currently looking at the whole legislation effectively of super guarantee and trying to see if there are other areas in the current legislation that might also get looked at as part of the Payday Super process. And that just we just wanted to acknowledge that it could be broader as well than just the timing of the payments, and noting at the moment with the current system that those honest inadvertent errors can result in a super shortfall, can trigger the charge, and the charge includes an admin component of $20 per employee per quarter, and then interest. And once you add that all together, that's a significant amount. So just noting in terms of that process, that we find that often in the industry, the shortfall is quite nominal or small, but once you add in those other components, it can be a significant amount. And that whole aspect of the nominal super sort of shortfalls is important to your industry, and we are advocating for that to like a de minimis rule, if they could bring that in. So if the shortfall is less than $20 or less than $100 or something, that's quite lower. So whatever the quantum is, just noting that you may have experienced that yourselves in your organisations, that can turn into quite what would seem an unfair or unreasonable situation once you have to add in the other components compared to the quantum of the shortfall. So I think that probably covers off that slide quite nicely there. And so what are we talking about? In terms, coming back to quarterly, is the current basis, and moving over to a Payday Super model, what can we expect to see? Well, there's three areas, key areas in particular, that will be affected by this proposed new system. The first one, the super guarantee shortfall itself. So of course, in the legislation, it is currently based on a quarterly basis. So if the employer does not contribute enough or contributes an incorrect amount, etc., then that is looked at over a quarter. So that would need to change. Secondly, interest and administration. So the super guarantee charges, as I touched on briefly before, includes the shortfall and then the interest and the admin component. So, so where there is a shortfall, it triggers the charge. The charge includes interest and admin as well. The admin component is $20 per employee per quarter, as I touched on. So that's a quarterly basis at the moment, so that will need to be revisited. Do you change the quantum? Do you even, well, we have certainly advocated for removing the admin component altogether, but that's just some of the discussions that are going on at the moment. We will have to wait and see what a new system may include or not, but just noting that currently it's on a quarterly basis, so that will be impacted. And also the interest component. So the interest component of a super guarantee charge, if you are facing that system, then it is actually calculated from the first day of the quarter that was impacted. So if it was the March 2024 quarter that unfortunately an allowance was missed for super guarantee, for example, that should have had super guarantee on it, and there's a shortfall, and you lodged the super guarantee charge statement today, then the interest would run for that March quarter from 1 January of that quarter right through to the date of lodgement being today. So just noting that, of course, there will need to be some structural changes there as well. And lastly was just the maximum contribution base. Some of you may be aware that there is actually a maximum that employers are required to contribute. Now, I'm just talking about the super guarantee legislation here. It's not to throw in too many other complications, but of course, there can be enterprise agreements and awards and individual, contracts, employment contracts. So there could be some other contractual basis. So I'm just talking about the super guarantee legislation at present, and it does have a maximum contribution base. That's based on a quarter. Now, for the 24-25 year, that is currently $65,070. So it is expressed in an earnings type basis. So just to give you a rough idea, if you have someone employed for the full year, or if you're looking at their sort of annual salary, then that would be approximately $260,000. So any individuals that are employed that are on at least that amount, the maximum contribution base is available to have a ceiling on the amount of super that will be contributed. So just trying to point out a few things that you can see that will need attention in a change to a new regime. So moving on, I think this is my last slide now. Some closing comments before I hand over to Steph is just to note that significant changes are coming. We are waiting direction from the government on the framework at present. We, at the time of we are unaware of any developments that are out there in the public domain as yet. And once we do start to have some developments, we would anticipate at the very least that super guarantee contributions will be required on a monthly basis under any government changes. So please start to think a little bit about your organisation, the systems you use, I guess the requirements that you might have under your systems and processes, to note that that's what we would expect at a minimum would be a monthly contribution. That they will move away from quarterly is a safe bet to certainly to anticipate in future. Now, some of you may already be just contributing on a monthly basis, and that's great. And just my last point there on this slide is just to take care regarding super guarantee compliance. So I've spent this time talking about Payday Super, giving you a little bit of a refresher on what the current system is, so that you can appreciate some of these changes that are coming, proposed to come in a couple of years. However, just before we close, a reminder that currently the ATO is active, very much so. I know Steph and I have been involved in areas for our clients in terms of things like super guarantee reviews and notices coming out of the ATO. And just my last point, noting that being aware that single touch payroll world that we live in now does give more transparency regarding super guarantee compliance. So on that note, thank you for your attention, and I will now hand over to Stefanie Merlino, who's going to currently continue on talking about superannuation topics and give us some recent developments, and also Steph is going to kindly talk more about contractors. That is a very topical area that we have. So I will now hand over to Stefanie. Thank you.
Thank you, Judy. And that was a really great overview of Payday Super. So 1 July 2026 will be here before we know it. So very timely to revisit those changes, and hopefully we'll see some more specific updates on how the redesigned superannuation regime will look from Treasury. So my topic today, as Judy indicated, I'll continue on covering off on superannuation, but mostly in the context of employees versus contractors. I know for not-for-profit organisations and for-profit organisations, this is one of the biggest challenges that exists at the moment in relation to always topical distinction between an employee versus an independent contractor, and it continues to attract a lot of attention by the regulators as well. So just a bit of context, and I'm sure you've probably heard me talk about this if you've listened to previous webinars on contractors, but it was 2 High Court judgments that put the spotlight on these arrangements. Back in 2022, it was February, on the same day, the High Court handed down decisions for personnel contracting and then for JAMSEC. And what those cases did was set out the importance of the contract between the parties. So what are the terms that have been agreed between the 2 parties? Those terms should consider the common law factors, and I've set those out on the slide, or I've set some of those out, those factors around control, integration, remuneration, whether there's the ability for the contractor or individual to subcontract or delegate, who's providing tools and equipment, who bears the risk as some of those factors. And where the contract is silent on any relevant factors, you would then look past the contract at the practical reality of the arrangement between the 2 parties. Now, with those cases, there was a requirement for the ATO to revisit their guidance, and that's why I've set out on the slide 2 pieces of guidance that were issued on the 6th of December 2023 Practical Compliance Guideline 2023-2, which I'll cover off in a bit more detail on the next couple of slides, and Taxation Ruling 2023-4. Now, the relevance of that taxation ruling is that was withdrawn and reissued in draft as TR 2023-4 DC1 to cover off on the superannuation components of employee versus contractor. So I'll be covering off on that revised ruling after PCG 2023-2. So on the next slide, what this PCG does is set out the Commissioner of Taxation's compliance approach, as it really does recognise the challenges that can exist when an organisation is seeking to classify their workers as an employee or a contractor. So it's the substance of the contractual arrangement that's important. And as I mentioned, you can look past the terms of a contract if there's anything that's silent, or if you want to look at the reality of the arrangement in practice. And that requires looking at the totality of the relationship. So all of those common law factors. I did take two extracts from the slide. So the previous slide set out at table 1. So if we go back to the previous slide, table 1 sets out the consequences of a worker's classification where a worker is an employee of the engaging entity. So I do want to go through this and table 2 because it sets out what are the impacts if you are classifying a worker firstly as an employee. So for an employee, the engaging entity needs to report payments through its single touch payroll. So the individual will have to be paid through payroll. As a result, you'll be withholding under the pay-as-you-go withholding regime. You'll have obligations to make superannuation guarantee contributions. If you don't, you will then be subject to the SGC. You'll have FBT obligations on any non-cash benefits that you're providing that individual, and you're not entitled to claim GST credits for wages paid. Consequences for the worker. So they're essentially an employee. Therefore, there won't be an entitlement to an ABN in relation to that employment, and they won't be entitled to register for GST purposes. The next slide, table 2, sets out the consequences where a worker is classified as an independent contractor. So the engaging entity will typically pay that worker through accounts payable, not through payroll, so there will not be any withholding applied. Some organisations will have to report under TPA, the taxable payments and your reporting obligations. So those payments will need to be included in that. There might still be superannuation guarantee obligations, and I'll cover off on that shortly. That's where even though the individual or the worker is not a common law employee, they could meet the extended definition of an employee in the superannuation legislation. So that's important to know. If the engaging entity and worker are both registered for GST, the engaging entity can claim eligible GST credits. From a withholding perspective, even though the engaging entity would typically pay that worker through payroll, it's important to note, through accounts payable, not through payroll. It's important to note that if the worker does not quote an ABN, then there might be a need to withhold under Schedule 1 to the Tax Admin Act, or if the parties enter into a voluntary agreement, there may also need to be a requirement to withhold. For the worker, they'll need to make provision for income tax, assuming that there's no pay-as-you-go withholding applied. And that could be done through quarterly pay-as-you-go withholding instalments. The worker may be entitled to apply for an ABN and may have to pay GST, register and pay GST depending on certain thresholds. And they'll also need to consider the personal services income implications. So that distinction between employee and contractor is a really important one, as you can see the difference in tax and other obligations and considerations depending on that classification. So that PCG sets out at paragraphs 21 to 25 the ATO's risk framework, and parties can self-assess against the framework to understand the likelihood of ATO compliance activity. So there are 7 criteria that a party can work through, and depending on where they land for each of those criteria, you can then make a classification as to very low, low, medium or high. And that colour coding on the slide aligns with the colour coding in that PCG. So where you achieve a very low or low risk rating, the ATO will not dedicate further compliance resources if they agree with that classification and they were to look at this arrangement. Medium or high risk areas are the ones that you should really focus on, because they're the ones that the ATO is likely to dedicate compliance resources in the event of an inquiry or investigation. Those criteria that need to be assessed in classifying that arrangement will be based on the parties' arrangement, what were the intentions of the parties, what was the understanding, so were they both of the same understanding as to the nature of the relationship, what was the conduct, so how did the arrangement work in practice, and advice is an important one that looks at whether the parties or the engaging entity has obtained professional advice to support the classification of that arrangement. So as we move on to the tax ruling, this is that next ruling that was issued back in December but reissued in June as Taxation Ruling 2023-4DC1. In its original form, the tax ruling only set out the definition of an employee for pay-as-you-go withholding purposes. So essentially all of those common law factors, some information around each of those, and that is then what determines whether an individual or a worker would be considered an employee or a contractor. In the revised ruling, however, that PAYG section has now been set out at Appendix 1, with Appendix 2 providing guidance on the meaning of an employee for superannuation guarantee purposes. The previous ruling, SGR 2005-1, is the ruling that applied prior to this reissued taxation ruling. And it was issued back in 2005. So we're looking at a ruling that was nearly 20 years old and didn't reflect all of the changes that have happened in this space, including those High Court decisions I mentioned earlier. So that SGR 2005-1 has been withdrawn. That draft TR 2023-4DC1 is currently undergoing consultation. So parties were invited to make a submission as part of that draft ruling, which will be considered by Treasury and the ATO in that draft ruling before it's finalised. Submissions closed on the 9th of August. So we're now awaiting feedback, any changes, and then potentially or likely a finalised ruling. Now going through Appendix 2, so the reissued ruling provides that at subsection 12.1, if a person is an employee at common law, that person is an employee under the superannuation legislation. And as I mentioned, those common law factors are what determines whether an individual or a person is an employee at common law, and that's set out at paragraphs 18 to 82 of the ruling. You then have your expanded definition of an employee for superannuation purposes, and that's set out at subsections 2 to 11. Now, it's important to note only an individual can have a superannuation entitlement. So if you're engaging with a PTY Ltd or a trust or some other structure by way of an independent contracting arrangement, it's only those that are individual sole traders that could create a superannuation obligation, except in the instance where there could be sham contracting. And sham contracting is where the agreement does not reflect the true reality of the arrangement, so you can then potentially look past that structure that you've engaged with. But assuming there's no sham contracting, it really is your individual sole trader contracting arrangements that will need to be considered for the purposes of that expanded definition of an employee. Subsection 12-3 has specifically set that out on the slide because that is the provision that I see creating the most challenges for organisations, because it deems a person who works under a contract that is wholly or principally for the labour of the person to be an employee. And thankfully, we've got a bit more guidance and clarity in the draft ruling around what that actually means. So moving on to the next slide, I'll go through some examples in the ruling where a contract is not wholly or principally for the labour of a person. So where the contract contains a right to delegate, subcontract or assign the work, the contract is not considered to be for the labour of a person because that person can essentially pass or delegate that work to someone else. So for that contract to be considered not for the labour of a person, there needs to be the existence of a right to delegate, subcontract or assign the work. So it's the right that's relevant, not the exercise of that right. Having said that, the right needs to be enforceable. So it can't be a sham or incapable of exercise. It must be for the entirety of work and not for discrete tasks. Now, it is possible for the ability to delegate or subcontract to require approval or written consent of the engaging entity. That does not mean it doesn't meet this particular contract exclusion, but it really does need to be enforceable and capable of being exercised. The second type of contract, where the contract is not wholly or principally for the labour of a person, is a results contract. That's where the contract specifies a specific outcome and it's therefore for a result. So a party can perform a service by their own means. So in other words, they can use third-party labour, plant and equipment to achieve that contractually specified outcome. And typically consideration is for a fixed sum on completion of the particular job, rather than being based on time spent to produce that outcome. And then the third contract that is excluded from this particular deeming provision is where the contract is principally for the benefit other than the worker's labour. Now, this is really a question of fact, and it requires assessment by reference to the benefits that are received by the engaging entity. So this might be where a contracted service requires use of a substantial capital asset. This next slide, I provide an update on a recent tribunal case that considered the extended definition of an employee in the superannuation legislation. So it's Australian Turf Club Limited against the Federal Commissioner of Taxation. The taxpayer was the Australian Turf Club Limited, and the ATO issued notices of assessment for superannuation guarantee charge in relation to jockeys who participated in horse races between the 2010 and 2014 financial years. The SGC was not an insignificant amount, it was over $1 million. The taxpayer objected, however, this was disallowed by the Commissioner, and as a result, the taxpayer appealed for review of that decision through the AAT. The issue was whether the jockeys were employees per Section 12 of the superannuation legislation. Now, I have specifically set out on the slide subsection 12.8a, which I didn't go through as part of the taxation ruling I just discussed. So we'll note that that taxation ruling does consider this exemption or this deeming provision as well. It applies where a person who is paid to perform or present or to participate in the performance or presentation of any music, play, dance, entertainment, sport, and you can read the rest there. But essentially in this case, it was the sporting that performance that was considered to capture a superannuation obligation for the jockeys. The taxpayer contended that the jockeys were not employees as defined in the superannuation legislation, and instead jockeys were employees of the racehorse owners and or the trainers, and the payments that were made by the taxpayer to the jockeys for participating in races were payments that were made on behalf of the owners or trainers. So on this basis, the taxpayer argued that they did not have a superannuation obligation. Instead, they argued that subsection 12.3, being the wholly or principally for labour of the person, applied, and that the owners or trainers of the horses had the superannuation guarantee obligation because the owners had the contract with jockeys for their labour, and the labour was the jockeys' participation in races. The Commissioner disputed that subsection 12.3 was applicable and instead argued that subsection 12.8, which I just went through, applied. In that circumstance, the performer being the jockey, was deemed to be the employee of the person liable to make the payment, being Australian Turf Club, for that performance. The AAT found in favour of the Commissioner and held that the jockeys were employees of Australian Turf Club under that extended definition set out in subsection 12.8a. They also confirmed that only one person could be liable for payment for the same performance, and that multiple employers for one activity are not contemplated under the SG legislation. So an important case, particularly for any of those who operate in the sporting industry. Now, I know we've only got a couple of minutes, but I've got one last slide which I am going to fly through before handing over to Russell to close the webinar. My last update for today, and I know there's a number of you in the education sector who have joined the webinar. This is relevant for those of you who operate in Victoria and are a high fee non-government school. There was a change that was announced as part of last year's state budget in Victoria that meant that payroll tax exemption available to high fee paying non-government schools no longer applies for those schools that have an income per student in excess of $15,000. So from 1 July 2024, there is now a payroll tax obligation for impacted schools. The Minister for Education determines which schools will retain their exemption, and there's a section on the Victorian Government website that specifically lists out those exempt and non-exempt schools. So affected schools, depending on how much their taxable wages are, so where they exceed $10 million, not only will they have a payroll tax liability, which is typically imposed at 4.85% in Victoria, but they may also be subject to the Mental Health and Wellbeing Levy and the COVID Debt Levy. So for those of you who are impacted, no doubt you're already aware, as you've already started paying payroll tax from 1 July. That wraps up my content, so thank you, Russell.
Thanks, Stefanie. Yes, there's lots for everyone to absorb in those contents, and I think you know, there's a lot of practical issues. I'm sure many of those in the horse racing industry are quite concerned by the direction of that case around the jockeys and the potential risks that lie, because that was $1 million for up to 14, so there's a bit of time passed under the bridge since then. So it'll be no doubt one that everyone's watching closely. And similarly with the Payday Super, thank you, Judy, for sharing that. It's it offers a lot of practical challenges for employers going forward as to how to modify that. So we're coming right up on time. So for any of those questions that have been submitted, we will come back to you offline and reply to you, because I'm been under instruction that we've got to finish on time, and I thank you all for joining us today. So the questions that are there are very significant for not-for-profits to be able to ensure that they continue to meet their mission. So to manage their payroll costs, the timing of their payroll, and not to have money disappearing out unexpectedly that was otherwise destined to go to other purposes. So thank you all for joining us today, and thank you to Judy, to Stefanie for your presentations. I trust everyone's enjoyed that. We'll see you again the next webinar. Take care. Bye.